Welcome to Bar Chart's series of educational webinars designed to enlighten you on a variety of investment ideas and concepts, to inform you of the features and tools Bar Chart provides related to these concepts and offer you some trader's insight to help you make a more informed investment decision. Today's session, Beyond the Gamble, how to trade penny stocks for consistent success. Now, everybody dreams of hitting the lottery, and in the world of investing and trading, that'd be the equivalent of finding the next Nvidia or Apple before they become mainstream investments. The world of penny stocks offers just that, a venue for high reward and potential explosive gains. But like all high reward opportunities, it requires a greater amount of risk. And unfortunately, for many inexperienced traders, they look upon penny stocks as a get rich quick scheme and jump into them before they understand the volatility, liquidity challenges, the catalysts that drive price movement, and how to pick higher probability candidates, causing them to gamble away numerous losses in hopes of finding that one winning ticket. Hello, everyone. My name is John Rowland, Bar Chart's Senior Market Strategist. And in today's session, we're going to help you to identify tradable penny stock candidates. I'm going to try to teach you how to narrow down your selections using volume, liquidity, technical analysis, and chart patterns that are unique to penny stocks. Now, I know in the description for today's session, I mentioned risk management techniques and strategies to enhance a greater penny stock success. So I want to be straightforward with you. And while I was putting together this webinar, I realized that it wasn't enough time in the 15-minute session to truly accomplish what I believe are all the essentials, especially when it comes to risk management and strategies. So instead of rushing through and leaving you with the feeling of being empty or confused, I decided to break it into, or how to trade penny stocks into 2 sessions. So today, we're going to focus on candidate selection, technical analysis, and chart patterns. In 3 weeks, on October 30th, we will dive into the application and applying risk management and simple strategies to our selections that maybe we'll identify today. And hopefully, not only will this increase your consistency of success, but with the understanding that consistency and proper risk management will keep you in the game. Where instead of you just looking for lotto tickets will find you. After all, what is the lotto's motto? You got to be in it to win it. So I apologize up front, but I'm very convinced that the 2 sessions together will make for a more comprehensive webinar. Now, with that being said, please welcome our moderator and Bar Chart's project director, Jean Baker. Hello, Jean.
Good afternoon there, John. Mr. Penny Stock, I know you've been prepping for this one for a long time, and as you just explained, I never really thought of it. I thought penny stocks was going to be an easy thing to cover. You're finding that there's a whole lot more than just talking about what the penny stocks are. So
exactly. It's kind of like the more simple it is, the more complex.
Right. Well, I'm not going to delay you. I know you have a lot to cover, so why don't you get started with the first session here?
Okay, great, Jean. Just reminding you, today's session is for educational purposes only, and decisions to buy, sell, hold, or trade securities or commodities or any investments involves risk, and penny stocks certainly involve a lot of risk, and best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any loss or damages that you occur or as a result of trading or investment activity that you or anyone else engages in based on the information material that you receive through barchart.com and our services. Okay, so what is a penny stock? Well, they're typically priced below $5 and traded on the over the counter or in smaller exchange, but it's not limited to that. On the NASDAQ or even the NYSE, you could find stocks that trade below $5. But when we think about penny stocks, we're talking about those that trade below $1. Now, penny stocks do offer this idea or this presentation of high potential returns, but equally high risk. And that's because of their low values. They can enjoy explosive percentage gains. And it's not uncommon to see a penny stock rise, 100, 200, or 500% in a week's time. But equally common, they can fall as much during the same time period. Now, this is a challenge for us to manage this heightened volatility. So it's important for us to understand the risks that are associated with trading penny stocks. And as I said in the opening, traders who look upon penny stocks as get rich quick are doomed for failure. However, looking at penny stocks like any other security with a discipline, risk management, volatility awareness, and with some proper skill sets that are unique to penny stocks, you can greatly increase your success. So as I said, we're not going to spend a lot of time on risk management, literally no time, but we're going to spend most of our time today on identifying candidates. So let's start with candidate selection and understanding where the unique risks that are associated with penny stocks and how to recognize and assess them. So drivers and catalysts. So what causes these explosive movements and how can we turn a risk into a leveraged advantage? So penny stocks move from a variety of drivers, industry trends, government policies, fiscal spending, mergers and acquisitions, pumps and dumps. We're going to talk about that, and earnings reports. Now, what we want to do in our selection process is we want to focus on like macro trends. For instance, like the favorable industries or fiscal policy that promotes government spending in a certain sector, or corporate trends, mergers and acquisitions, again, and looking for, earnings growth for certain sectors. But we want to be conscious of pump and dumps and market manipulations. Now, the key catalyst for us to watch will be companies, well, excuse me, let me go back here. Penny stocks tend to, because of the liquidity challenge in them, penny stocks, the number of shares that are outstanding, or the number of shares they have, or their market capitalization, and limited institutional involvement to buffer price action, penny stocks, for a better word, overreact to news. So catalysts for us to watch, or key catalysts, is what news that we can look for in our selection process. So, company specific news, FDA approvals, partnerships, new product launches. Think about like biotech, right? Biotech stocks tend to take off when they get, approval to move to a different phase. Or you get a penny stock that partners with a large cap market leader. And the ones, you think about Nvidia at the beginning, that was a penny stock and it was just a component inside of computers. And, that was probably the beginning of, the Nvidia story. Sector specific trends. Again, we can talk about energy, biotech. AI right now is one of the more mega trend sectors. think about this in terms of where is capital flowing and where are investors looking for alpha. And you will notice that penny stocks will get swept up in the wake of larger cap movements if there is a connective theme. Market events and economic reports. So, think about what are the tailwinds for small caps, like, for instance, Fed rate cut cycle or a risk on appetite environment, and, seeing positive economic growth, through multiple sectors. So, tools for identifying catalysts. So bar chart, I believe, I know, I think does a really great job. And so let me just show you some places where you can find some catalyst information. So first of all, if I go into stocks and I go into stock market sectors, right, I can look at, and this is at the macro level now, I could look to see which sectors are performing over a variable of time periods. And what I probably want to do is I want to start thinking about what penny stocks could be falling in those sectors. But I also can break it down a little bit more. I could go into industry rankings and look at which industry groups are performing well, in other words, have high alpha or weighted alphas. But it doesn't have to stop there. If you go into some of these sectors or some of these groups, you're not going to find penny stocks, right? These are large to mid cap stocks. But the idea of where is the money flowing. But if you go into, say, sector top 100 picks, this is one of our features, and you sort by price, there are almost 10 or more stocks here that are trading under $5. So there is plenty of information that you can find to look for particular stocks, potential penny stocks. Now, it doesn't stop there. We could go back into our stock page and look at earnings. Earnings is a catalyst for price movement. Again, I'm going to sort by price and notice how many penny stocks that we have in here. Now, another spot where I can look for is in news. And we have a lot of different areas where we can find news. So first of all, if I go in for, say, exclusive, occasionally, if you come in here, you will see a bar chart exclusive story on penny stocks or a group of penny stocks or a sector of penny stocks. So there's a lot of information that you can find. Now, I think the best place and to start looking for, or a great jumping off point, is under the investment page. We have hot penny stocks. Can't be easier than that, right? So in this one here is we're going to sort or gather those stocks, penny stocks, that have the highest movement over the last 5 days and show an increase in the 5-day volume average as it relates to the 20-day volume average. So again, let's take this concept of the macro to the micro. So on any of our data pages, we can screen. So I'm going to come up here and screen, and this is what I'm going to, kind of encourage you to do. Is first thing I want to do is I want to check the industry box, and we are screening on hot penny stocks. And I want you just to type in the word sector and add that to our screener. And then I want to see what the results are. Then I'm going to sort by industry. And then this is where we're kind of doing that macro to micro, right? What sectors are the money is flowing into, what themes or what ideas that I have that are sectors that are or industries that I want to look into. For instance, you can see there's a lot of medical, biomedical penny stocks, and that is very common of penny stocks. But there are some very unique, right? Unique combinations, consumer staples and tobacco. One of the ones that I notice, here is it falls in the oils and energies, but it's Standard Lithium. There's been a lot of interest in lithium penny stocks of recent because Rio Tinto, a large industry leader in the mining field, has bought just recently, trying to acquire a lithium penny stock. So a lot of lithium penny stocks are actively trading now. Again, that theme of what the big boys are doing and how it can influence, the market at the penny stock level. All right. Liquidity and volatility. So both of these are going to have a profound impact on penny stocks, and that is because of a lot of reasons, but mainly because institutional traders aren't really trading penny stocks. Their participation doesn't buffer price action, and because of their small capitalization, they make it more susceptible to these greater price swings. Now, we can measure volatility in a lot of different ways. So one of the metrics that we're going to use in our risk management, and this again will be something we're going to talk about in our next webinar, will be the average true range, ATR. Now, if you're not familiar with ATR, this is a measuring stick. It's a volatility measurement, but it's also a measuring stick of probable price range. And we can use this tool to help us not only for targeting price action, but also for risk management. Bollinger Bands, another volatility measurement based on standard deviation. We can use that. And historical volatility if we have a penny stock that is trading options. So stay with me. I'm going to show you a couple of examples of that. All right, so let's go back to our penny stock page. And I'm going to go into flip charts. And, one of the stock, well, let's just go to this one, one of the first ones here. So first of all, where can you find average true range? Now, on an individual stock, you can look under what is called the technical section. You can find that. But if you're, let's say, in the flip charts, you go here where it says more data, click on that. And here it says technicals, and you can find the 20-day average true range. Now, in the session that we'll do in 3 weeks, we'll talk about maybe converting that to maybe a lower average true range, but it measures, it tells us, how much price action we can diss. It's not a directional measurement. It just tells us what the potential range is. Another tool that we can use is an indicator called Bollinger Bands. Again, more about standard deviation or price movement. So what Bollinger Bands can kind of identify for us is when volatility is starting to increase as our bands move from narrowing bands to widening bands. But when bands get super wide, that is also an indication that volatility has gotten too high, too fast, and that the market could have a potential reversal or what we call a mean reversion. Again, there are webinars in our archives that talk about how to use Bollinger Bands and ATR, average true range. The ATR one is called average true range, the Swiss Army knife of technical analysis. So I would encourage you to watch those. So the other aspect is in terms of, let me see where my notes are. Let's talk about, let's go back to our slides. Is, again, in that 3 weeks from now, we're going to really dive deep into this volatility concept of this relationship between volatility and risk management as both opportunity and risk. So again, that will be something for you to look forward to. Now, the other consideration is liquidity. And trading penny stocks with low volume can make it very difficult for us, especially as we're getting in and out. And that is usually directly related to wider bid-ask spreads. And low volume also can create much greater price volatility. But also, when you start looking at stocks that have high volumes, that can definitely help the liquidity risk. But you need to understand the difference between what is high volume and volatility and low volatility and high volume and high volatility. And that may be contributed to an extremely low stock price. Now, the final thought here, as I'm going to show you, is more of a trader's insight here, but that volume peaks during morning and evening sessions, or the morning session and the closing session. Maybe you've heard the expression that novices open the market and professionals close the market. So considering, again, this is going to be more of a generality and not an absolute, but considering closing positions for those of us who are willing to hold positions overnight or over multiple days, closing our positions in the morning sessions and looking to open them in the evening sessions. So let's go back to our penny stock page, and we're going to look at volume. So first thing I'm going to do here is, some of you might say, well, what is a threshold for volume for me in terms of trading a penny stock? And so for this first example here is 100,000 volume. That might be enough volume for us to trade, but I think what we need to do, and this is what I do, is we have to kind of put that in a nominal value. In other words, what does 100,000 shares represent in a dollar value based on the price of this stock? Now, notice that this stock trades for 1/10 of 1 cent. So let me put that in perspective for you. If I wanted to buy 1 million shares of AMBS, I could do that for $1,000. So 100,000 volume represents $100 worth of nominal price action. Not probably a lot of volume for us to trade this stock. This stock is probably still very, very volatile. Now, let's look at the one just below it, BURU, right? 32 million shares, and this is a $1 stock. So we're talking about $32 million in a nominal value. This stock has certainly a lot of volume, a lot of liquidity, and probably not as much liquidity volatility risk as the other one. Now, if we go to, say, look at high volumes, right? Again, right? Look at accredited solutions here. Again, it's a 1/10 of 1 cent stock where it traded almost 250 million shares. Yeah, I think that's a lot of volume to eliminate price risk in terms of the bids and asks. Notice that the range today is only a few ticks. But again, put this in a nominal value, 250 million, where I can buy 1 million shares for $1,000. So we're talking about $250,000 worth of trading. Yeah, I think that is probably a better threshold, but this is how you can do that math and try to figure that out. Again, if we look at Weight Watchers, which has been very, very active today, this is a $1.70 stock where it's traded 134 million shares. Much more liquidity, much less price volatility because of the high volume. All right. The other thing I was kind of mentioning to you is looking at volume in terms of, let me see if I can find the candidate I wanted to use, using volume as a way of measuring in terms of time of day. So again, I'm going to go back to the flip charts, and I'm going to change my chart from dailies to 15 minutes. And let me see my notes here. Is this a good one, or was it this one? I think it's this one. Okay. So notice that you see how this, now I'm breaking down volume in terms of time of day, and where you can see the spikes in volume. But notice here, here's 315, where we had a little bit of a price rally throughout the day, right? A rise in volume. And then the next day you get that spike in volume, right? Where did, the market close? Again, not a standard, right? Not set in stone, but bigger price movements between the openings and closes. Again, here's a close here, and then here's an opening. Again, here's a close here, and then, our opening range. So again, I think if you're going to trade penny stocks, or you're going to hold them overnight, just be aware of this idea that if you get into a stock and then you have a big gap up in price during the opening session, it's probably a better time to get out than it is to get in. And if I'm looking for confirmation or opportunities to get in the market, I'm probably going to wait to the end of the day when I start using technical analysis to say, hey, now I'm getting the closing price above or below or at a value that I'm more certain about a confirmation. All right, let's talk about certain unique scenarios that relate to penny stocks, and they're called paid promotions and pumps and dumps. So paid promotion is basically, it's common tactics for, a company that will pay a promoter or third-party groups or newsletters or influencers to promote a particular stock or promote their stock. And these promotions can include anything from social media posts to emails to direct mailing, or even, accessing, through a third-party contact. Now, think about this as, folks are really, companies are really, what they're trying to do is they're trying to get their stock noticed, or that they're going to trying to promote the stock to get the price to rise, and in hopes that, maybe we'll get an analyst to cover it, or that they'll raise the market cap of that stock so that it gets promoted from the pink sheets to the big leagues. So again, in terms of news, for instance, under collaborators, if I can look at, a lot of different types of news stories that are third-party providers. Let's go to Weight Watchers, for instance. Today, this is a news story that came from Stock Stories. And if I click on that, notice it says contributor content. I just want you to be aware is that we disclose to say, hey, this could be or is, we're getting paid a compensation for placement of this news story. So I think it's important for you to kind of ask this question is, why is this news story here, and who benefits from this news story, or who created that news story, and how are they benefiting from it? Now, this is not scrupulous, right? I mean, this is really how business is done, and this is not any different than, a pundit going on CNBC and telling you why they like a stock, right? Or a CEO going on Jim Craner's show and telling you how great things are, right? It's just them promoting their stock, making you aware of. And there's certain laws and rules that hopefully will protect us from any of them lying. Now, unfortunately, there is a gray area, and that gray area is pump and dumps. And if you've seen the movie Wolf of Wall Street, where they were in this what they called a boiler room type thing, where brokers and dealers look at penny stocks as inventory, and whatever it takes for them to sell that inventory. So we have to be aware of pump and dump schemes from unscrupulous dealers. Again, there are rules, right? If you get caught in a pump and dump scheme, you could go to jail. But how can we use this as a benefit, and how to help us decipher the risk? So again, some points to think about. Check for disclosures. Who's creating that news article? If that news article is coming strictly from the stock company, right, then that's probably more reliable. But if it's coming from, let's say, one of these services, right, who's going to benefit from that stock? Again, asking yourself, what are they going to get out of it? Look for unusual volume spikes. Typically, pump and dumps will be one-day spikes. If this is truly a stock that is on the move, you're going to see multiple days of either rising volume, maybe a spike in volume, but at least rising volume or consistent volume. But if you just have a one-day volume event, especially if you have a one-day volume event at tops, that could be a sign of a pump and dump. Has the stock all of a sudden just showed up in every one of your social media, or it's on every forum that you might be using? That could be an indication of a pump and dump. Avoid stocks that have limited financial or business information. Again, if you go to like their website and it's Joe's dog walking service, and there's a picture of Joe walking 5 dogs, and that's all you get, then I think you need to be a little bit susceptible of what could be going on there. Changes in liquidity. So, again, a rapid drop in volume. Again, it may be near a recent top or after an explosive movement. Again, a one-day event. But watch for the bid-ask spread. Is it narrowing or is it widening? And so typically what you'll see in a pump and dump scheme is, as you're getting towards, let's say, the top of the market where they're going to dump, you'll see that the bid ask will widen, not narrow, when you usually see a market moving. And this is because what happened is the pumpers will just bid enough to support the market. But what you'll typically see is that the last trading price will trade below the ask, probably in the middle or maybe even closer to the bid. They're just looking to hold the market up so they can sell it. So if that bid ask starts to widen at the top of a market move, that could be a dire sign that you are part of something different. All right. So again, because of the risks versus, let's say, the benefits of paid promotions and pump and dumps, for most retail traders, you probably want to avoid these types of stocks, right? But if you choose to trade these, and I'm not discouraging you from trading them, make sure you use proper risk management techniques. Again, something we're going to spend a little bit more time with in our next webinar. We're going to talk about stop loss positioning and size positioning. In other words, I'm not going to go all in on one of these stocks. Okay. All right, let's get to technical analysis, challenges and adaptations. All right, so traditional technical analysis often fails because penny stocks have a lot of false breakouts. Again, we talked about this manipulation, and because of low institutional involvement, you get a lot of what I would say false breakouts or limited price movement, wide price movements. So, I think the word fail here might be a little bit of a strong word. I think a better phrasing could be, this type of traditional technical analysis might create more false signals. And that's because a lot of traditional technical analysis looks at a little bit longer time, a higher time frame. And so they might be a little bit late to the party or slow to recognize price movements for our quicker volatility penny stocks. Again, liquidity and extreme volatility can render a lot of these traditional technical analysis ineffective. So what are some adaptations that we can look at in technical analysis to help us with trading penny stocks? So let me read about the three that I'm going to discuss, but then we'll go to a chart and I'll show you how you can visualize the difference here. So, traditionally when we think about stocks, you might hear things like the 50-day moving average or the 200-day moving average. But penny stocks, right, their time frames or their price movements are a lot shorter. They have these little bursts and then pauses or bursts and retreats. So using, let's say, a 10-day or a 5-day moving average, you might receive a more accurate signal and give you a clearer picture of what that penny stock's volatility. Again, when we talk about risk management, these values might also help us in our risk management. RSI, traditionally we think about RSI in terms of overbought and oversold conditions as 70 and 30, but maybe consider adjusting them to 80s and 20s to account for these exaggerated movements, because penny stocks can be exaggerated for longer periods of time. And MACDs, or moving averages, convergence divergence, typically will use a 1226 as their first and second moving average. Think about maybe adapting those to shorter time frames to give you quicker momentum shifts. So again, let's go to back to our web page, and again, hot penny stocks and flip charts. And again, I don't like this chart, this stock, but let's see, let's find this one here. Okay. So up here, he says templates. So I click on templates, and under category, you have my templates. One of the features of being a subscribed member is that you can create a lot of templates, especially a Premier member. But bar chart does offer you some default templates. And if I scroll this down, I can get one template that's going to give you the RSI and 3 moving averages, the 50, the 100-day, and 200-day. So you can see here, again, with penny stocks, a lot of these moving averages are going to be flatline, right? They're not really giving us a lot of information. But what I can do is I can come back up here and click on that moving average. Here's the 200-day. Let's change the 200-day to 20 days. And then let's click on the 50 and change that to a 5-day. And notice now our moving average now is more in line with our price action. Again, I can use this as a signal that I'm seeing volatility or that this is a potential stock that is moving, but I can also use it in a risk manner as well. Now notice here our RSI has been overbought for a long period of time. But again, if I come back in here, click on RSI's defaults and change this to 20 and 80, 80. Notice now only until just recently, based on our price action, are we in what we would consider an overbought scenario. Again, if you go into templates, bar chart, and we have a MACD with volume. Again, the standard for MACD is 12, 26, and 9. So you might want to consider putting this on maybe like a 6 and 12 or 9 and 12, lowering those original moving average valuations to a little bit shorter time frame to reflect the short bursts or impulses that penny stocks typically trade. And so let's talk about some penny stock specific tools that are really good to use. Something called the volume weighted average price. Again, there's a webinar about how to use this if you're not familiar with it. I'm going to show you how to do that. We'll talk about alpha, weighted alpha in a second. And again, if your penny stock has options, we can look at options flow. So again, let's go back to our penny stocks and let's first talk about weighted alpha. So I'm going to under performance, there's a default view, and you can see here we have weighted alpha. So typically what I do is I'm going to click on weighted alpha, and I want to see those penny stocks that have a higher weighted alpha. Now, weighted alpha is based on stock price movement over a 1-year period, but it gives a higher weighting to recent price action. Now, I'm not necessarily looking for the highest alpha. All I'm trying to just do is looking for a stock that has a positive alpha, meaning that it's in an uptick or trending environment. What I might do here is I might start sorting by 1 month percentage, or maybe in a 5-day percentage. I can screen on that. And what I want to look for is those stocks that are having a good performance in a short time that still have a positive alpha. So let's look at that. So we see we have GEVO, BW, and this one ICBU. So those three, let's look and see what those three look like. So here's GEVO, and we look at this over the last year, right? It was basically a stock that was trading flat, but now it's on the move. Is this the kind of the chart pattern you feel more comfortable going long in? I think I would say, yeah, I would definitely be interested in this one. Here's BW again. If I look at this over, a year period, this is a stock that's just starting to move, right? Starting to make some progress. So again, a more positive outcome in terms of a probability. And the other one was, here it is, ICBU. All right, again, another stock that was languishing, doing nothing for almost a whole year, and now is starting to outperform. So looking at weighted alpha to kind of give us that promotion of a positive price movement, and then looking at it maybe a shorter time frame to find those, identify those ones that are actually moving. So the other one was average volume, or volume weighted average price. And here we can see it says anchored. And so what we're going to do is we're going to add that. And what's nice about this one is it kind of tells you where the average price of those who are in that stock, and also it can tell us if the line is moving up or moving down or is flat way. Are they adding or are they accumulating that stock? Now, for instance, in this one here, what I might do is I might anchor this from the origin of the move. So in other words, here we are back on August 8th. This is the one the stock broke out. So I'll come to the average weighted volume anchor, and I'm going to change the date to August 8th. So I can look at, are we still accumulating? Is it still rising? And also, this might also become a risk element for me in terms of setting price stops or telling me an actionable level where, those that are in, this is where they're starting to lose money. And then again, let's go to, here's Weight Watchers, which has been very active today. You know, if I'm lucky enough to find a penny stock that trades options, again, a risk management tool and a volatility tool will be using our historical volatility as a measuring. All right, so where are we at? Okay, we're kind of right on time here, Gene. I'm feeling good about today's session. Oh, options flow. That's what I wanted to talk about. All right. So again, if I'm lucky enough to have a stock that trades options, I'm going to go to options flow. And what I really want to do is kind of, this is just really, again, that big picture element. I want to just make sure we have a nice positive sentiment if I'm buying, or bearish sentiment if I'm selling. But this is also where I can start to see what strikes are actively trading and what time frames those expirations are. So this will kind of give me an idea of where our traders are thinking that price can go to. Again, you know, profit targeting, but also maybe a little risk management. All right. Okay, chart patterns and candlestick formations. All right, so let's start with penny stock specific chart patterns. We're going to look at 4 specific groups. We're going to look at rocket ship rallies and moonshots. We're going to look at something called the random wanderer, death spirals, and heart patience. And then finally, our stairmasters. So let's go back to bar chart. Now, I created a watch list as I was putting this webinar together. And these aren't recommendations on this page. These are just examples of these different types of chart patterns. So let's go to that. Okay, so the first chart pattern we're going to look at is rocket ship rallies and moonshots. So a rocket ship rally typically occurs over multiple days. And just like a real rocket, like if you ever watch one of these rockets on TV, you're going to have a liftoff point. And that usually is where you break out, either from a range or you break out based on, you know, a rise in volume. Typically, you'll see both of those. And again, rise in volume will be a good confirmation. And then you'll have boosters, right? When you think about how a rocket gets into space, you have the initial rocket takeoff, and then you have a booster, then you have a secondary booster, and then eventually, you know, you have that third booster that gets you out of the Earth's atmosphere. So typically the ladder booster will be that blow off, right? And each time one of the boosters takes off is that usually will pause or stall at a previous level of resistance. And you can see how that played out in this particular stock. So these make for nice candidates because you'll know where a target's going to be, a former level of resistance, so you can do risk management that way. But also, when the rocket starts to fall back to Earth, so to speak, these levels where these booster levels are can act as levels of support. And now you can kind of notice that today, we fell back into this area where the booster was before, again, where it was supported by volume. And it's the market's holding, right? So again, you might say, hey, here's a stock that's run away from me, but I'm going to wait. I'm going to wait to see what happens when price returns. Now, this is more indicative of what I would call a moonshot. Again, much shorter period of time. In this case, looks like it's about 3 days, maybe not 2 days. And typically what you'll see is a big price movement in 1 day. And then after that price movement, you'll see a significant drop in volume. Again, these are more likely to be pump and dump type stocks. Again, here's another one. right? Notice that the big volume was on the liftoff. Now, this was a little bit more than 1 or 2 days, but what did volume do as we got higher and higher, right? Volume was falling, less and less participation. Here's another example. And this is more of your classic, right? Here's your pump. 1 day, big volume spike, no volume the next day, price falls back. Again, another example. Now this one might be the beginning of a first stage, right? We didn't really get that big blow off, a little bit of a blow off. The pump certainly on the initial takeoff, that's a good sign, but no follow through in volume. I would really like to see some kind of higher volume on that. And let me go to this last example. So again, this is more of our rocket ship rally. And again, this is kind of that idea of here's our liftoff, there's our first stage. Yeah, market came back, a little bit of a correction, found support, right, from the area of where the origin of our liftoff. Then we got another kind of a booster here. Again, notice, look at our volume here, not dropping off very significantly, not at least not falling back to what would have been our average volume. Still a little bit of accelerated volume. And then here's our second booster, right? And notice how we found an area of resistance. So this stock might be a great stock for a potential breakout candidate. And where would that breakout occur? Well, I want to see another volume spike where we get above this resistance. And what would be my target? Well, my target would be the next level of resistance. So then I can measure how far that target is, what is that potential reward, and how much risk will I allow myself to take back. And in this case, looks like I would probably risk about 20 cents to make about 40 cents, about 2 to 1. So that might be a good risk reward ratio. All right, so that brings us to our next candidates. And these are what we call the random walkers. So again, here is, this one actually changed a little bit since this morning, but this looks like a rocket ship rally, right? Booster stages, right? Little blow off. But again, let's look at this in terms of a longer time frame. It's been kind of wandering. So a wandering walker or a random walker, typically you'll see them in a range bound for extended period of times. Now, what's nice about these is that they tend to have a little bit more liquidity, but also you can know that you have an established range. You can look to buy dips on these or look to buy the low end or the bottom of your range, and that makes for a very easy risk management. But these also make good breakout candidates. Now, notice what is going on here with this particular stock is here's our kind of our moonshot, right? 2 days, spike in volume, no volume follow through, price is kind of falling back. But we're what? We're still inside of this range. So this could be a potential breakout candidate. What we need to see is price to what? Break out above that second stage, right, on volume. But what's probably more likely is going to happen on this one is it's probably going to fluctuate back into that range. Here, another great example, right? Here's a stock that has been in a range for a long period of time. And we've tested the high and low multiple times. Now, what's unique about this one, and you can look for this pattern, is notice that just recently, within the last couple of days, we literally tested the low and made a new low and tested the high. Now, we didn't make a new high, but we got right to it. So what this is telling us is any buy the dippers or sell the rippers have been satisfied. And there's really nobody who is going to continue to support this or resist this, right? in the short run. So what we would do on this one is there's a higher probability that we're going to range in here for now. But as far as a trading candidate, I can't buy this until it gets below here, or I can't buy this until it gets above here. And this is a really nice way to define a range of price in terms of breakout potential candidates. I'm going to be very patient on this one, even though maybe volume here is supporting the idea that this stock is going to go higher. All right, our next candidates are what we call death spirals and heart attacks or heart patients. So this is our stocks that are attributing a downtrend. And so they're making lower lows and lower highs. And you can see that here. So that would be kind of a death spiral. But notice how you have a lot of short intermediate rallies. Some of them are rocket ship rallies. Some of them are moonshots. Some of them are rocket ship rallies. Some of them are moonshots. But what are they doing? They are not getting above certain levels. They're not making higher highs. They're making lower highs. And they're not being supported beyond the initial impulse by volume. So this is a combination death spiral and heart attack or heart patient. Here's RIG. Now this is interesting. This is actually an NYSE stock. And you can see how this one has been just in lower lows and lower highs. It's just been in a death spiral. But what's just kind of interesting about this stock is not too long ago this was a $150 stock. So there is probably something majorly wrong with this company. Again, there's a reason why some of these types of stocks are traded lower and why we probably want to avoid trading them. Again, more of a death spiral. But what makes this one interesting, this is why I drew this line here, is we can start using regular technical analysis, or at least chart patterns. So this looks like a double bottom or a W pattern. That's usually a sign the market has found support. Now, what is interesting, if we draw a line and look to the left, notice that support is where we broke out. And what would those of you who are chart pattern folks, what does this look like? A cup and handle, and notice multiple layers of resistance, and then this is where we broke out. So I think this is interesting. This is a stock I would definitely be looking at. But again, what do I need to achieve? I need to break this cycle of lower lows and lower highs. So when we come back in 3 weeks, we're going to look at risk management in terms of, yeah, I can trade these death spirals on these rocket ship rallies and these moonshots, but I'm going to use very strict risk management rules. And so any indication of a change in momentum or a change in price action, I'm going to get out of them. But I would rather look at these candidates, and these are my favorite, and this is what I call the stair masters. So have you ever heard of the expression, bulls take the stairs and bears take the elevator? Well, I want to find these stocks, right? Those that are exhibiting higher highs and higher lows. Is impulse, drawback, impulse. And every impulse is confirmed by volume, right? First of all, these make for great candidates, but it also is very easy to manage our risk, because we'll know right away when this trend is over. We'll know right away when price action has changed. So again, think about this: staircase, impulse, supported by volume, right? Stair, here's our stair, basing, impulse, supported by volume, right? And pull back to a level of support where our impulse was, right? Staircase, impulse, supported by volume. Here is that GEVO. We saw that that was one of the stocks that had a large alpha in price movement in the short term. Again, look at this, right? A little bit of an impulse, support, impulse, support, right? This would be a great candidate. Matter of fact, in setting up this webinar, I put in, to be honest with you, I put in try to buy a dip on this one. It's now run away from me a little bit, so I'll probably wait and see on that one. So full disclosure, here is a stock that I have in my portfolio, one of the few penny stocks I do have. And the red line is where I purchased this stock, again, on the impulse of a breakout. But notice, right, again, very structured, higher highs and higher lows. Very easy for me to manage my risk. Now, the black lines here represent areas of targets for me in terms of where, when price gets there, I'm going to do some kind of risk management, either lock in prices or move my stop. Now, again, full disclosure on this one, I don't own the stock outright. I own option leaps on this one. I think they are January 26. And again, when we talked about why I chose this one, this is a company that is in the battery storage business at the utility level. In other words, they create batteries for utilities to store extra power. And that is certainly one of the trends, that is this crossover of utilities have been one of the outperformers in the most recent 3 months, and that AI story of how we're going to manage all that demand for power. So do your own due diligence on this one. Don't take this as a recommendation. I'm just giving full disclosure. Here's Red Cat again, right? Nice staircasing price movement. All right. So we're at the top of the hour, Gene, so I want to kind of move on. And I know that, we try to talk about keeping these under an hour, but like I said, that this one was, the more I worked on it, the longer it got. So think about chart patterns in terms of flags, pennants, and triangles, right? These are much better for trading candidates. Again, look for those patterns that are showing us potential breakouts. Again, for patterns like head and shoulders or double tops and bottoms, right? Be careful of those fake outs, and that are typically found in penny stocks. Candlestick patterns, focus more on dojis, engulfings, hammers, stars. So let me go to and show you one quick example of that. So let me go back to my watch list here, and I'm going to go to I need to change my chart to candlesticks. And I think it's this one, NGO, yes, okay. So those of you who are familiar with candlesticks, right? It kind of shows you the sentiment of the market on that particular day. So notice how a lot of these candles have small bodies and large wicks that go below the candle. This is a sign of bullish sentiment, right? These are called hammers, and there's a doji. This is where the market is trying to push price down, but buyers step in and push price back up. And this is a very bullish sign. Even this red candle here, where price went lower, that from the previous day, this is still a positive candle. The price went down all day, and then it finished up here. And now today we're having looks like another high, but even though we are at lower price from the previous day. So there's a lot of upside pressure, candlestick pressure on this particular stock. So those would be hammers, again, engulfing patterns. Multiple candle patterns in candlesticks, tweezers, 3 white soldiers rising, 3 methods, Tazuki gaps. We'll look at some of those in 3 weeks from time. Just remember that to confirm patterns with volume to avoid false signals. Okay, so let me do this before we jump away because I'm at a little bit over. I do see a couple questions here. I want to try to answer them, and then I want to just kind of tease you guys what's coming up. So yeah, Ron has left. So Ron, yeah, we're going to definitely talk about penny stocks, stops from them in our next video. So see, it looks like I've answered a lot of these questions to you already. So says, does a scenario exist where I try to sell a penny stock and there's nobody to buy it? Certainly in pump and dump scenarios, you might have that in that case. So that's why it's important to understand price volatility and also liquidity, right? That example where I showed you before in terms of volume. All right, so here's our teaser for our follow-up. So in our webinar in 3 weeks, we're going to go a lot more into risk management. We're going to talk about risk and reward ratios. We're going to learn how to develop what is called a unit of risk based on how much capital we're going to trade. We're going to talk specifically about stop loss placements, and we're going to learn how to use average true range as measurement of volatility, but also as a risk management tool to help us choose stop points, but also helping us in calculating our position size. We're going to learn how to do position sizing and how those elements that are in the ratios and in the formulas that help us to do that position sizing. Again, I don't want to be trading penny stocks on an all-in. And then we'll use that risk reward ratios to help us define exit strategies and look at the benefits of scaling in and scaling, and again, not going all in on every trade that we find. And this is going to help us mitigate some of our risks, wait for more confirmations and price action, think about rocket ship rallies, locking in profits, reducing our risk, flexibility, and then eventually what we could do is think about this. I have a stock that I bought, and now it's gone up. Maybe it's $1 stock, and now it's a $3 stock, and I sell out half my position. Well, I know that if I sell out half of my position, not only do I'm going to put profits in the bank, but I'm also probably going to cover the risk of the other half of that position. So in that case, no matter what that stock does, if it goes to zero, I'm still going to make money. And so then I've really created a lottery ticket, haven't I? Because a week from now, or 3 weeks from now, or a year from now, or 10 years from now, I own that stock for free. And that's how I can create that lottery ticket for success. All right, Wayne, thank you very much for the comment, Wayne. I appreciate that. All right, so that's the tease for next week. Again, I want to remind you that, if you're interested about learning how to do multiple templates or custom views or creating a lot of watch lists, it's important for you to be a subscribed member. Premier members have unlimited access to all those modifications. Okay, until next time, Gene, let's go to our upcoming webinars. Next week, we're going to talk about using our bullish moving averages. We're going to break this down in 2 parts. We're going to look at trend following systems and then how we can use these bullish moving averages to help us decipher or look for trading opportunities based on different types of trend following systems, but also how we can incorporate them into some very risk-defined option strategies. Some very simple risk-defined option strategies. How we use the moving averages and how we use them to help us select our strike value. So I hope that you guys stick around. Stuff. So just a quick question here. I'd say day trading stuff, please. So Al, yeah, when we do the risk management segment of the penny stock, we'll look at more of a from a day trader's perspective. But again, a lot of these stocks we probably want to catch a little bit of a momentum wave, maybe a 2 or 3 day momentum wave. So it's it's a little combination of both. It's difficult to be honest with you. It's difficult to attend to two different masters, either do it on risk management on day trading or momentum trading. But there are some rules that we can kind of overlap on that. So again, another question, will this be available on review? Again, all of our webinars will become archived, and the slides that I have shown you today will be attached to that webinar later this afternoon. Correct, G? All right. Thank you very much for everybody for joining us. Until next time, best of health, manage your risk, and the good of all trading.